Hello, welcome to the weekly market brief program, prepared with contributions and research by Yasar Atolye. This week, the markets were quite busy. The US Federal Reserve, Fed, made its first interest rate cut after a long time. Stock markets hit record high after record high. Turkey's risk premium saw its lowest point in years.
Yes, it was truly a busy week.
Let's thoroughly discuss these developments that stand out in the week of September 15-19 and what they mean for you. Now this week, all eyes were definitely on the Fed meeting, right? As expected, they lowered the policy rate by 25 basis points, that is 0.25%, bringing it to the 4.25% range. However, the decision statement and Chairman Powell's speech didn't seem very dovish.
Exactly. The interest rate cut decision was already, bought by the markets. The main focus was whether this cut would continue or not. The Fed used quite a cautious tone here. Yes, the decision was made with a clear 11-1 vote, with new member Miran requesting a bolder cut of about 50 basis points. But Powell continued to emphasize the inflation risk in his speech. Although he acknowledged some signs of weakness in the labor market, he said that this cut is not due to a recession expectation, but rather a precautionary measure, a risk management step against potential deterioration in employment conditions. In other words,
So, the economy is heading for trouble, and they avoided sending the message that interest rates will be cut rapidly. But what about the future projections? What do those famous pinpoint graphs say?
there is a similar cautious stance there as well. The median expectation among Fed members is that there could be 2 more 25 basis point cuts by the end of 2025. However, they only foresee a single cut for 2026. This somewhat contradicts the market's more aggressive pricing, which expects more interest rate cuts from the Fed. Interestingly, they raised the growth forecast for 2025 from 1.4% to 1.6%. But they did not change their inflation and unemployment forecasts. This again reinforces the message of no panic for now, just staying cautious. There were also members who dissented from keeping the interest rate unchanged at the previous meeting, Waller and Bowman. The decision to cut rates in this manner seems to have somewhat eased the political pressure discussions on the Fed.
How did these complex signals reflect on the markets? Was there any movement, especially in bond yields?
Isn't it possible? Absolutely. Before the decision, U.S. bond yields, which had fallen in anticipation of a rate cut, turned back upward after Powell's cautious speech. For example, the 10-year bond yield had dropped below 4%. It closed the week around 4.13%. The 2-year yield also moved similarly, reaching approximately 3.58%.
The return curve is still inverted then.
Yes, what is striking here is that the yield curve is still inverted. In other words, short-term interest rates are higher than long-term ones. This is generally considered a sign of an economic slowdown. But for now, the Fed says it does not expect a recession. This situation actually shows that the market is still pricing in uncertainty about the Fed's next steps and inflation concerns.
What did the dollar do globally then? What's the situation on that side?
The dollar index, namely DXY, which measures the value of the dollar against the other 6 major currencies, strengthened after the Fed and closed the week at 97.65. This, of course, is a potential pressure factor on emerging market currencies like ours. Of course, there were other global developments during the week as well. The central banks of the UK and Japan kept interest rates steady. US President Trump's visit to the UK and the announced $250 billion investment agreement, as well as the anticipated phone call with Chinese President Xi, were among the geopolitical headlines. There was also news that China banned some companies from purchasing Nvidia chips. However, it seems that the impact of this was limited.
Let's talk about the record-breaking US stock markets. The S&P 500 and Nasdaq closed the week again at their peaks.
Yes. The increased risk appetite following the Fed decision and some positive company news officially boosted the stock markets. The S&P 500 ended the third consecutive week with gains and reached a new record on Friday with a 0.5% increase. The technology-heavy Nasdaq rose by 0.7%, renewing its own record. So, we can say that technology stocks once again served as the locomotive.
This week, what caught my attention first was how some specific company news ignited the market. For example, the news that Nvidia will invest $5 billion in its struggling competitor Intel. Or how Apple's new iPhone 17 sales started off well, boosting its shares by 3%. There were also positive expectations for FedEx. It seems like the market wants to focus on good news, doesn't it?
There is definitely such a mood. Of course, the Fed starting its interest rate cut cycle is generally a positive signal for risk assets. However, some analysts are warning that valuations, especially in the S&P 500, are somewhat inflated, and the risk of profit-taking has increased. On the Nasdaq side, technical indicators also suggest that the overbought zone is approaching. So yes, there is optimism, but there are also questions about the sustainability of this rally.
So, in light of these global developments, let's look at the Turkish markets. How did Borsa Istanbul fare this week?
Borsa Istanbul, that is the BIST 100 index, finished the week with a 2.223% increase, closing at 11,294 points. During the week, there were some fluctuations due to internal political developments, such as the decision of the Supreme Election Council regarding the CHP Congress. Honestly, the index even fell to the level of 10,000 points. However, especially with the purchases on Friday, led by banking and technology stocks, the index recovered and managed to close the week positively.
This was exactly what caught my attention the most this week. The index finding support at a critical level like 10,000 points and being able to close the week higher. What does this mean now?
From a technical perspective, we observed that the 11,000 level is functioning as a good support. If the index moves upward, the 11,400 and 11,500 levels will serve as resistance. A close above 11,275 is positive. If stability is maintained above this level, the upward movement could strengthen. In this recovery, we can say that the partial decrease in the internal political risk perception, or at least the postponement of uncertainties, has been effective. Next week's domestic confidence indices and global data could be more decisive in determining the index's direction.
What was the situation on the USD TRY side? I don't think there was much movement there.
Yes. The dollar to TL exchange rate had a quite calm week and closed around 41.37. This means there was almost no change compared to the previous week. This calmness was influenced by both the relatively weak trend of the global dollar index DXY and the central banks, namely CBRT, maintaining a tight monetary policy stance.
I think the most remarkable development is the risk premium in Turkey, isn't it? We saw a historic decline in CDS.
It was definitely one of the most important positive developments of the week. Turkey's 5-year CDS premium, which is the cost of insuring against the country's default risk, is simply called the risk premium. During the week, it fell below 240 basis points, reaching 237. This is the lowest level in the past 5 years. The last time we were at this level was in February 2020. The week also closed at 240 basis points.
So, what is behind this decline? Why has our risk perception suddenly improved so much?
We can say that several factors worked together. The slight easing of tension in domestic politics, the implementation of more predictable policies by the economic management, and the determined stance of CBRT in the fight against inflation increased investor confidence. This positive atmosphere was reflected not only in CDSs, but also in Turkey's foreign debt securities, namely Eurobonds. For example, the yield on a long-term Eurobond maturing in 2047 decreased from around 8% to approximately 7.60%. Additionally, Turk Exim Bank's successful Eurobond issuance of $600 million further confirmed this positive sentiment.
So, what about TL-denominated bond interest rates? What did they do as CDS was falling? CBRT had cut interest rates, but I think the rates are still high.
Yes, the situation there is a bit different. Although the central bank has cut the policy interest rate to 45%, TL bond yields, especially for long-term maturities, are maintaining high levels. The 10-year benchmark bond yield closed the week at around 31.7%. The 2-year benchmark yield is close to 40%, around 39.85%. With the decline in CDS, we actually saw a short-term pullback in the 2-year yield, which decreased from 37.5% to 36.8%. However, high inflation expectations are limiting the decline in interest rates. But it should also be noted that there is significant interest from domestic investors in TL-denominated government bonds, that is, DIBAS, domestic government debt securities. The latest data indicate record levels of inflows. So, even though there is some flight to dollars or gold in deposits, we observe a strong interest in TL in debt securities. This is an interesting divergence.
Really, a very interesting divergence. Well, let's move on to the commodities. Gold was probably the star of the week. New records were set.
Absolutely. Gold ounce, which is approximately 30 grams in international markets. Expectations before the Fed meeting and the impact of the elegant dollar pushed it past $3,700, reaching a record high of $3,732. However, following the Fed decision, especially with Powell's cautious messages, some profit-taking occurred, and the week ended around $3,650. Still, there has been over a 40% gain since the beginning of the year. It's an incredible performance.
What were the main reasons behind this rally, and why did it pull back a bit after the Fed? Could you briefly summarize?
Certainly. The main factors fueling the rally are, as we know, inflation concerns, seeking safe havens due to geopolitical risks, ongoing gold purchases by central banks, and generally a weak dollar environment. The pullback after the Fed can be described as a situation of expectations priced in, realities sold off. Increased risk appetite, Powell's hawkish stance on inflation putting some pressure on gold, the strengthening of the dollar, and technical overbought signals also played a role.
So, where is the technical support located?
Technically, the $3,600 level is an important support. Although the low interest rate environment is positive for gold in the long term, such profit-taking should be considered normal in the short term. Some experts even mention $4,000 if Fed rate cuts continue. So, the potential still seems to be there.
I think silver followed gold as well. What was the situation over there?
Yes. Silver also tested the range of $42 to $43 per ounce, reaching its highest levels since September 2011 and closed the week above $43. Silver is supported both as a precious metal and because it is used in industry, benefiting from inflation, a weak dollar, and expectations of economic activity. $40 is now a psychological support level, and around $50 is discussed as a long-term target if the resistance above is maintained. Petrol prices remained relatively calm around $63.50 for the week. However, potential new sanctions against Russia continue to pose a risk to oil. Let's also note that.
Let's finally look at cryptocurrencies. What's the situation with Bitcoin? Has it attempted $120,000, or are we still waiting?
Bitcoin challenged the $117,500 resistance within the week, but failed to break above this level. Although it pulled back somewhat due to sales from there, it managed to stay above the $115,000 support and closed the week around $116,000.
So what does this mean? Has the rise ended, or is it just a pause?
Technically, the $115,000 level is an important support. As long as this level is maintained, we can say that the upward potential continues. If the resistance of $117,500 is surpassed, eyes will shift back to the historic high of around $124,500. Analysts generally expect a period of consolidation or sideways movement at these levels, honestly. However, they also see a high possibility of a new peak attempt afterward. The interest rate reduction process initiated by the Fed is also supporting Bitcoin in the overall macro environment. But of course, some analysts, like Benjamin Cowen, point out the risk of a sharp correction after a possible peak. So, we should keep this in mind.
What happened on the Ethereum and Ripple sides? Was there any movement in those?
Ethereum closed the week with little change around $4,500, essentially ending flat. Technically, it appears to be trapped within a symmetrical triangle formation. This indicates indecision between buyers and sellers. The breakout direction, upward or downward, will determine the next move. Roughly, support levels can be monitored at around $4,300 and $4,500, while resistance zones are at $4,600 and $4,800. Especially, closes above $4,600 are significant. Ripple, on the other hand, tested the $320 resistance but couldn't break through, ending the week around $3. There, the $270 level, specifically below $273, could accelerate the decline if broken. For an upward movement, a break above $320 is essential. Overall, risk appetite in the crypto market and, of course, Bitcoin's direction will continue to be decisive.
So, which data will we focus on next week? What's on the economic calendar, and what should we pay attention to?
Next week, the data flow will be busy again. Domestically, on Monday, there is the Consumer Confidence Index, and on Tuesday, the Real Sector Confidence Index and Capacity Utilization Rate. These can be important for TL assets as they give us an idea about domestic demand and overall economic confidence. Globally, on Monday, the September preliminary PMI data from around the world will be very critical. These data carry important signals about whether the global economy is slowing down or not, and can directly affect risk appetite. So, careful monitoring is necessary. The most important data of the week will be on Friday, from the US, the Personal Consumption Expenditures, PCE, Price Index. This is the indicator the Fed considers most when monitoring inflation. Therefore, it can guide market expectations regarding the Fed's future interest rate moves. On Thursday, there is also the US's final GDP data, which will be followed as well.
It seems that the markets will experience active days again next week, especially with the PMI and PCE data.
Absolutely. As we come to the end of this week's in-depth analysis, the question that remains in mind is perhaps, while the Fed has started its interest rate cut cycle and markets are hitting record highs, how sustainable is this optimism? Especially considering inflation risks, with Powell still cautious on this matter and geopolitical uncertainties still on the table, what points should investors be cautious about? I think it's worth reflecting on these questions.
See you next week. I wish you a profitable week.
See you soon.